Dino, if you invest in the stock market, why should you care about the bond market?
Why you should care if you're a stock investor only and you don't do bonds, and why should you care about the bond market?
Yeah.
The bond market is a critical part of equity investing. Why? Because bond yields are technically risk-free rates.
What is that?
Okay, so let me take a step back. When you how is a stock, how do you value a stock? A stock's value is based on the future potential earnings, income streams of the stock, right? It's called a discounted cash flow model. In the discounted cash flow model, when you value a stock, you use a risk-free rate. US bonds are technically used as risk-free rates because why? Full faith and credit of the US government. It's risk-free if you invest in the bond. You get your money back, the US government won't screw you, right? So when you use these models to calculate valuations, right, the higher the rate means more money is needed to be earned in the future to meet that threshold of a risk-free rate. It's called a discounted cash flow model, right? So when you invest in equities, when the interest rates are really low, equities do better because the threshold for them for their future earnings are a little bit lower with the lower interest rate. If the bond market is selling off and the rates are really high, the hurdle they have to go after to meet that risk-free rate to return you as much as the treasuries can return you is much higher. So they have to make more money. So that's why it's important when you invest. You need to know where the bond market is going because it affects the valuations of your stocks. That's why it's important.